Hi, good afternoon. Welcome to the marketplace. Coming up, government to resume issuance of domestic bonds from next year as it struggles to raise funds through Treasury bills auction. Also ahead, we spotlight Ghana-US economic ties. How would policy shifts captured in Trump's One Big Beautiful Bill Act impact us here? It's a conversation for our exchange. My name is Darrell Kwao. Thanks for being with us. Details coming up. Thanks for staying with us, everyone. The government is now aiming to resume issuing domestic bonds starting next year, advancing from the previously planned timeline of the last quarter of 2025. This update was detailed in a notice to the IMF outlining the country's debt and expenditure plans for the remainder of the year. More in the following report.
The new timeline is coming at a time that government is struggling to raise the needed funds through the Treasury bills auction. Government is said to have missed out on some significant funds due to its policy of not taking all the bids offered by investors that participated in the Treasury bill auction over the past month for this year. Government, in the said letter to the IMF, is hopeful that returning to the bond market may help in raising some significant funding for its operations. The Finance Ministry is being forced to return to the market from next year because there are fears that its funding needs will be elevated from next year. Therefore, it needs to find some innovative means to deal with this challenge. There are plans to target some private investors locally and later look at the option of some offshore investors. Government was forced to suspend domestic bond issued some years ago due to negative effect of the domestic debt program.
Well, more on this, I'm joined by Manager of Macroeconomic Research at GCB Bank PLC, Courage Buti. Good afternoon to you, Courage. So what do you think of this move? What are the potential benefits or risks for Ghana resuming domestic bond issuance next year?
Good afternoon to you and your listeners. We have been off the market for some time and for good reasons. Thankfully, the debt metrics are going the right way due to a number of factors. We've completed domestic exchange, external exchange, we received credit rating upgrade, we've had the CD appreciate, and the debt metrics are looking good. We cannot continue to do short-term financing, as in T-bill financing, perpetually. It exposes you to high risk for refinancing risk. It's not sustainable. You can't fund any large project or long-term project with that. And we need to create or recreate opportunities for the local market as well. So it's a good move, but we needed to navigate some of the clauses in the domestic debt exchange as to one, the clear market clause, which I believe we've gone past that. But the next thing is, at what rate are you going to do a bond issuance that will not be detrimental to the rate on the DDE bonds? I think that is a consideration for the market. Remember, those bonds were done something averaging around 9% as coupon rates. Today, if you want to issue a bond, will you be able to do it at 9% or what rate? And the requirement is that clearly you must not do anything that puts the participants in the debt exchange worse or make them worse off. And I think that is one of the impediments. So with where rates are now, we see the market rate, where they are trending now and where they are headed to. It looks like it's getting closer to what the DDE rates are. And if it comes anywhere close, then you would have navigated that problem also by issuing new bonds. And if the market is open, the rates are aligned, and then we can begin to come back to market and raise some longer term bonds to fund our aspirations, as opposed to staying at the short end. And you'll be doing so also without jeopardizing the fortunes of those holding the old bonds, or making the market unattractive for them. Remember, the governor said he wants to bring lending rates down to some 10%, and you look at the dynamics of things, where things are headed now. It looks like market rates are correcting, and if we sustain the fiscal effort, it should correct towards a level that is comfortable. And it is when we get to those levels that issuing a new bond will not make the holders of the DD bonds, if you like, disadvantaged.
Well, how might government struggle in raising funds through Treasury bills impact our overall debt sustainability?
Well, I mean, so debt sustainability is your ability to afford your debt obligations as they fall due. To a large extent, I think with the development now, we've seen that. But the issue is, if you accumulate so much at the short end, and you have seen recent auctions, 7 billion maturity it has become a normal occurrence. But previously, these were under a billion T-bill maturities. They've now become 7, 8, 10 billion thereabout. Imagine a week, and every week you're having maturities coming up, and you have 10 billion, 15 billion, 20 billion maturing on T-bills every week. If your cash flow dynamics do not support that, you are approaching default. And that is some conversation you don't want. So you need to have a way where you are reducing the frequency of such large maturities, and you are staggering it a bit over the curve. And you can achieve that with a bond issuance, where coupon payments are twice a year, and then you can actually spread it such that you are not having lump sums or chunky maturities coming up on the regular. That is the way we would sustain market access and all that. So you want to avoid a situation where there is so much maturing every week that puts a huge burden on you to refinance. And I think that is what they are seeking to do with trying to re-enter the bond market.
And Courage, how could this shift affect interest rates, investor confidence in the Ghanaian financial markets?
Yeah, so investor confidence, interest rates are a mix of, if you like, sentiment on the market, the fiscal positioning, the risk, the emphasis due to time value of money. If I see inflation going up, I will demand as much so that I compensate myself, preserve the value of my currency. So these things interplay. The most important thing at this point is that government has been disciplined, at least in the first few months of the administration, and we need to find a way of sustaining that. If we do that, and inflation comes back to the target band of 6 to 10%, it lays the foundation for rates to be lower for longer. Remember, before the crisis started, T-bill rate was about 12.5% or so, 91 day, and then the 364 day wasn't above 14%. It was within that range. Those were the levels we were playing at before the crisis hit. If we anchor inflation within the target band, if exchange rate problems are dealt with and the fiscal overruns are curtailed, we should have rates in those lower ranges, which support government financing agenda. It also supports cheaper credit to the real sectors of the economy, and that is how opportunities will be created for everyone, really. So sustaining rates at such low levels will depend a lot on what the fiscal and monetary side of the equation are doing, and how that, if you like, stimulate growth in the real economy, and how that generate liquidity that could be flowing through that cycle, credit cycle in the economy.
You talked about financial discipline, fiscal discipline, rather. So how does the government balance this, the need for financing and then fiscal discipline in this context?
Well, and that is how we must be measured in some of the promises we make and the things we do. Yes, we are a developing nation. We need resources to develop, but access to those resources also depends on your ability to pay, the confidence the market have in you, and a number of other factors. So while we want to develop, let's be measured in how we develop and the impact of the project we are funding. For instance, if you want to do a kilometer of road, being a developing nation, you need to actually do your assessment carefully to say, what is the impact of this kilometer of road on, say, productivity, employment creation, and all those? And you do projects that have the highest multiply effect, fund those with maybe public resources, and then find other financing models that are probably non-debt or wouldn't impact your debt metrics on a number of others. So focus on the project that have high impact. If it is bankable, it's commercially viable, then you may want to consider how a GIF, Ghana Infrastructure Investment Fund, or catalyzing some other public private partnership to develop such. And if it is so purely social, then you can look at how to put that on the government budget. If you find that mix, you would attain your development goals without overly jeopardizing your debt position. But that balance, it's an intricate one, will require a lot of tact and discipline to achieve. It's not an easy thing, but that is how we must be very tactful and creative about our financing needs to be able to meet our development aspirations while also maintaining a sense of discipline in our fiscal administration.
Yeah, a final one. The mid-year budget review is on Thursday. What's your anticipation? What would you want to hear?
This year is a stability budget. I think we all agree to that. And the minister calls it delivering the shock therapy. My expectation will be that we do not overly distort the path. I know the audit of some of the arrears has been completed. There is that tendency to go full scale into some of the stall projects and all that. But the reason, and we can all agree to this, the reason we've seen exchange rate appreciate, inflation fall sharply, and the macro balance seem to be returning is that the fiscal side, we haven't spent so much. It means Ghana's problem largely is the fiscal. And I expect the mid-year review to find ways of maintaining that discipline. Yes, we would spend a bit more in the second half of the year, but then it should be measured. And if revenues are falling short, the diagnosis should be what is triggering the shortfall and how can we cover that? It should not necessarily be in new taxes. We've seen introduction of maybe a 1 cedi per liter kind of levy on petroleum and all that. I am not all for new taxes necessarily, but how to maximize collections from existing handles and how to be creative about roping in or bringing in new taxes and all that to close the revenue gap. If we generate so much in revenue, we can spend so much and there will not be any imbalance. But the problem is that we are not generating much, but we have to spend, and it creates such a huge imbalance. I don't expect major policy statement. Probably the 24-hour plus economy will find expression in the budget now that they've adopted the policy. And a number of other initiatives around agriculture and all of that will find expression. That is not the issue for me. But my issue is that this budget, we shouldn't change the tone to now all of a sudden up the gear in expenditure when it's not matched by revenue. I think that is what we expect to anchor the stability we are seeing. And when confidence is built and the market is looking all attractive and all that, we can attract private capital from FDIs and other sources into the local market, into your PPP arrangements, and that will deliver the capital goods while government focused on delivering the social goods that make life better for everybody. That is my expectation from the budget.
All right.
Just keeping it to the minimum. Yeah.
Thank you so much, Karish Buti, Manager Macroeconomic Research at the GCB Bank PLC. Appreciate your time with us on The Marketplace. You're watching The Marketplace on Joy News. We're taking a short break. When we come back, we'll be talking about Trump's One Big Beautiful Bill Act and why you should be concerned about it here in Ghana. Don't go anywhere.
Government was forced.
All right, welcome back to The Marketplace. Time for the exchange. All right, welcome back. As Washington pivots inward with the sweeping One Big Beautiful Bill Act, Africa finds itself navigating new global headwinds from rising remittance costs and tougher U.S. visa rules to shrinking green finance and shifting trade dynamics. With AGOA hanging in the balance and Ghana's economic ties to the U.S. facing fresh uncertainty, what should our business leaders and policymakers be watching most closely? Joining me is AGOA Ejechum, Chief Executive of EBII Group, a leading advisory firm connecting African decision makers to global finance and policy arenas to help unpack the real implications of this landmark U.S. law for Ghana and the continent at large. Thank you for joining us on the exchange, on the marketplace. Thank you, AGOA. So first off, Ghana receives billions in remittances annually, much of it from the U.S. diaspora. How concerned should we be about the new 1% remittance tax under the Act? And what can Ghanaian policymakers do to mitigate the impact on households and small businesses?
Well, good afternoon, and thank you for having me this afternoon. Yes, so Ghana does receive quite a lot. It's estimated that the country receives between 2 to 2.5 billion a year from the US alone in remittances. And so, yes, the 1% tax will increase the total charges on an estimate. Ghana, or I would say in general, remittances cost between around 7.9% in fees on an average. So that 1% will increase that figure to almost 9%. And that, in terms of what does that mean for the country, we are looking at around $23 million a year that is going to be lost in remittances to these 1% fees. If we look at the figure of the 2 to 2.5 billion that comes into the country, that's a significant amount of money that is lost from healthcare, from entrepreneurs, and also from education. And so I will encourage the Ghanaian policymakers to engage directly with the U.S. authorities to seek some kind of relief from these taxes. But at the same time, also efforts should be made at home to reduce transfer costs through better financial technologies.
Yes, and with the U.S. scaling back support for clean energy under the new legislation, what risks do you foresee for Ghana's renewable energy ambitions, and how should we position ourselves to attract alternative sources of green finance?
That's a very interesting question. So yes, the beautiful bill has rolled back several sort of U.S. Clean energy incentives. And this is directly going to have an impact in Ghana. So if we look at Africa as a whole, Africa currently needs about $100 billion a year to be able to meet their clean energy goals. And they do receive at the moment less than 20 billion of that money. So already there is an issue there. You could see that they're not getting the sufficient funding, and that includes Ghana in total. So this rollback is going to have a significant effect, especially given that a lot of the funding was coming from the U.S. The U.S., both private sector and public sector, is also shifting towards fossil fuel and pulling away from clean energy projects. Ghana must look beyond U.S. partners. They must look to countries like the UAE, places like the European Union, and also other philanthropic organizations. I will also encourage that, they do that, but as well as blended finance models that share the risk between both public sector and private sector is going to be key for this to happen.
Let's talk about what everyone is talking about, the new visa fees and validity restrictions affecting African nationals. What does this mean for Ghanaian students, professionals, and families with U.S. ties? And how can EBII Group support mobility and opportunity despite these barriers?
Yeah, so the new visa fees, it came into effect actually 8th of July, so this month. And yes, it's affecting about 31 countries, including Ghana. And of course, previously you could go to the U.S. Embassy. After waiting for almost a year for your appointment, you could get a visa for up to 5 years, multiple entry. Now that has been reduced to one single entry, and it's only for 3 months. This is going to affect students a lot. It makes it more costly. There are several other fees that has also increased for this visa applications. So yeah, there's going to be a significant impact on Ghanaian students, professionals, and even families. And yes, for business travelers, I will encourage that Africans or Ghanaians should be looking at, I would say, trading within the continent more. EBII Group is addressing this. We are hosting the African Leaders and Partners Summit in partnership with the George Washington University in September. And we are bringing in several leaders from across Africa, from Europe, and also the Trump administration to have a lot of these very critical conversations and to see what can be done as a result.
Yeah, another hot topic is the Africa Growth and Opportunities Act. So with AGOA not extended in the One Big Beautiful Bill Act and no new frameworks in place, what are the trade risks and opportunities for Ghana? Should we be worried about a vacuum in U.S.-Africa trade relations?
Yeah, there is some kind of a risk there. And whilst members of Congress in the U.S. currently are still calling for the AGOA to be extended, it is clear that the future, even if it's extended, and we are hoping that by September, I know that when Trump hosted the 5 African leaders 2 weeks ago, that question of AGOA was brought up, and he said, well, we will look into it. So we're hoping that something happens. Of course, AGOA shouldn't have been covered in the beautiful bill, but there should have been some mention of some trade relationships. We're hoping that it's extended, but even if it does get extended, which we don't know if it will be a very different looking AGOA from the previous AGOA. It will be more focused on mutually beneficial sort of trade relationship rather than the previous AGOA with so much tariffs. I will encourage that the Ghana will work more harder by improving its trade systems, exploring sort of new materials and staying very close to the U.S.-Africa trade discussions. But I will encourage the country to be positioned in a way that will bring so much value to the market.
Yeah, as your final one, you've emphasized the need for Africa to remain agile and proactive. What role can the African private sector, particularly in Ghana, play in shaping future engagements with the U.S.? And how is your group facilitating that through initiatives like the ALP Forum?
Well, thank you again. So back in April, we hosted the African Leaders and Partners Forum, again, alongside the World Bank IMF spring meetings. And we had several leaders, including someone from the Trump administration, who is the Deputy Assistant Secretary. He stressed on the fact that the U.S. is looking to work with the African innovators, especially those that are providing solutions, not just for African problems, but global problems. And so there's really the way forward will be for the private sector to innovate, be innovative, come up with solutions that is way beyond Ghana, that will catch the attention of the United States, because they are ready to partner, of course, mutually beneficial. But also the EBI group, yes, we are constantly engaging. We are partnering with several organizations here in the U.S. And of course, even with our current our summit that is coming up in September, we have the diaspora banking community, and these are some of the major banks that has been led by the diaspora in the U.S. They're looking to engage, they're looking to support the continent, especially given that the U.S. government and the private sector may not so much be focused on the continent. I would say the diaspora is going to be playing a role, and we are working with them on that as well.
All right. Good to see you and great to speak with you, Adjoa J. Chum, President of the EBI Group. Thank you so much for joining us for the exchange. And that's the marketplace, everyone. More news on our website, myjoyonline.com/business. Ghana's cocoa export volumes fall sharply by 50% despite the rise in earnings in 2024. Read more on that, plus other stories on our website, myjoyonline.com/business. Thanks for watching. We will be back same time tomorrow.